What's next? Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network, and Danielle Park is back for our bi-weekly discussion. And world economy continues to weaken. Japan doubles down on 15 years of reckless, ineffective economic management. We've got a whistleblower at JP Morgan that nobody listened to. And Danielle, how are you?
Hey, I'm good, thanks. Yeah, the world's quite a mess at the moment.
Yeah, well, didn't just happen overnight. The world, from my vantage point, has always been quite a mess. It just seems to get messier and messier. And, until there's accountability in the system, until somebody out there wants to change it for the better rather than a self-serving utopia for banksters, nothing is really going to happen, is it?
Yeah, well, I think that the global economy continues to shift down. And I think that that's where this rubber is eventually hitting the road, because although they've been able to, goose financial assets with round after round of intervention from central banks all over the world, you see, there's Japan, the poster child for QE, been at it since they cut rates in 99, and then they started QE in 2001. We're in something like the 9th inning of their QE efforts, and they're back in recession, Kerry. 3rd recession since 2011, 4th recession since 2008. So I think that they're sort of the poster child for these monetary experiments, and they are clearly showing everyone that it doesn't work. Now, some people will discount that example by saying, well, they have no immigration and an aging population problem. We actually have the aging population problem in most of the West, but it's true we have different and more inclusive immigration policy in most places. So that is a difference, but I still go back to, look at the global GDP estimates that have gone down steadily over the last 3 years and are still being ratcheted lower, Kerry. Every time that happens, you're opening this wider and wider gap between these insanely priced financial assets, profits in corporations that have been goosed by buying those insanely priced financial assets and making those assets go higher in the process. That gap just keeps going higher and the growth lower and the risk to capital greater by the moment. So there's going to be some big bang, Kerry. It can't have things stretched like a rubber band to extremes like this and not expect some really wild snapback at some point. Of course, everyone's in the game of guessing when that'll be. Some people are quite confident that it's going to be not for a few more years. I've heard every argument from, another 5 years of a bull market, which would be incredibly unprecedented, to, imminent declines. And the fact of the matter is no one can actually say, because this band has been stretched so much that it is impossible to guess when that, quick fix back is going to take place.
Yeah, well, like they say, Danielle, something's got to give.
Something's got to give. There's no doubt. Yeah.
And the system is very frayed. At least American banks, courtesy of the American taxpayer, you and I, are liquid now. But, because of these derivatives, you really don't have any idea how fragile they really are. And
well, actually, you do, I think, have. Let's put it in relative terms. I believe they are much more fragile than they were in 2008, and we saw that they were actually insolvent in 2008. You have a lot of. It's very difficult for the policymakers that rode everybody into this disaster to come clean and speak truthfully about how screwed up it is and how many mistakes they've made and where we're at. But you get every once in a while a significantly removed participants. So, for example, this week in Beijing, Jamie Karuna, who's the general manager for the Bank of International Settlements, which, as you know, is basically the board of central bankers in the world. So Janet Yellen and Mark Carney and Stephen Pelosi and all these, Mario Draghi, they all sit on this international board of bankers. Okay, right. And they have these quarterly meetings, and basically, the speech coming out of this latest get together in Beijing was the general manager saying things like admitting just what we just said, Kerry, admitting that the buildup of imbalances in the world is put us back at the risk of a massive financial crisis. We've got an impaired financial sector. We've got massive debt overhang in the world, and the seeds of these problems that materialize in the bust were sown during the past few years of this supposed boom. And history has taught us that these large external debt problems create these big blow-ups that come every so often, typically about every 5 years. And so, he's, on the one hand, he's admitting that the world is awash in a debt trap right now. And then at the same time, again, it's a cognitive dissonance, because he's saying that, but at the same time, those same bankers are the guys who orchestrated the whole thing, right? This committee ensemble can admit what individually they continue to promote. In other words, they continue to promote, there's Draghi this week saying we need more and more and more. We need to figure out a way to buy assets. And thank goodness you have the odd sober attendant like, the head of the Bundesbank, Jans Wiedmann, saying, no, sorry, Germany wants to be debt free. So we've watched you guys do this crazy stuff all over the world. We've watched Japan. We have so many examples now to thank you for trying all that. But Angela Merkel was reelected in September on the platform of a balanced budget. And guess what? Her government just proposed a balanced budget for the first time in 45 years, Kerry. Now, these are what I like to think of as fresh thinking examples. In other words, everyone's been mired in this insane narrative for the past 15 years that you can add debt and stir and that will be sufficient to correct the debt problem. We've come to the point where that's the comedy of absurd. Watching what's went on in Japan this week with, them talking about the Bank of Japan having to do even more quantitative easing, and you see this huge surge in the Nikkei. And then Abe has to come out with the embarrassing announcement that, oops, we are in the midst of the next recession. So, you've got these policies that are just run ragged, seriously, running everyone ragged. And at some point, those with something to lose. So if you look at it this way, the most indebted people tend to be reckless and crazy and running desperately. Those who have something to lose tend to be the ones that say, wait a minute, I don't want to end up broke. I don't want to end up with nothing but debts. So that's when they tend to cut that raft free. And I think that that's what Germany's doing right now. So they had to cut a bunch of expenditures. They're up against all this criticism in the world of people saying they're not being aggressive enough. And, the officials in Germany and the people with capital and actual money, not debt, there are saying, wait a minute, why we aren't about to start underwriting the prolific habits of our brethren in other countries who want to, literally bankrupt themselves. They've bankrupted themselves. They're not going to bankrupt us. So it's interesting. It's an evolution. I know it's been painfully slow, but I think after 15 years of this nonsense now, from when the tech bubble burst in America, we have some evidence that there's a bit of fatigue on this stuff.
Yeah, so you think the chickens are finally coming home to roost, huh?
Well, I just know, my partner has a great analogy. He says you can't fill in a hole in your driveway by digging a hole in front of it to take the dirt, because you still end up with this hole in your driveway. And there's potholes all over the place. Now, a lot of people have been siphoning money out of the system hand over fist. And I actually think that's what the whole bailout system was in 2008, 2009, all the programs, and then the QEs that began. And I think that the central bank, again, who is populated by a panel of the bankers in America, they have a regular meetings with the members of the banks to say, hey, guys, here's what we're going to do. It's a complete mess, but we're going to flood the system. We're going to give you every opportunity to make off like bandits. For the love of God, just make hay, like build up your coffers and squirrel away money and, do everything you can to juice the system, because we've only got a finite window here. It's not going to last forever. And when it bursts the next time, we won't be able to bail you out the same way, because clearly we don't have any money left. So, I think that was literally the plan. It was sold as all these noble purposes of helping the economy and employment, but I think it was extremely focused and planned about reliquidating certain participants, and it successfully did that. So,
yeah, well, the scary thing is, like you said, I don't think they're going to do it again, huh?
Well, from what? And we got what?
Print it up like
we have 700 trillion or so of derivatives now in the world. We have more debt on every level of society, from household to corporation to, governments. And the corporations have not been, so here we were talking about this before the call. Here's a couple of really significant things I think that are going on. I've been talking about the strengthening US dollar through this chaos as a major factor dominating many trends in the world and driving many trends in the world. So the strengthening US dollar as a relative safe haven, as a relatively liquid place to park capital, has been, let's not forget, 40% of S&P profits come from international sales. So a strengthening dollar is now hurting the corporate profits on the level of international sales. At the same time, look at America, look at Canada, Kerry. Where has the growth come from since the so-called recovery began in 2009? It's come from the energy sector, right? It's come from the massive overinvestment during the commodities bubble that generated all these new technologies and abilities to extract, which drove a bunch of job growth. And in your country, Texas has been driving the bus in terms of most of the job growth, the Bakken in that area. In our country, it's Saskatchewan and Alberta primarily. The rest of the country has been not participating to much extent at all in this recovery. It's all been driven by those two sectors. And now what's happened, Kerry? The price of oil is in a supply glut, just as the global demand is weakening further. And you've got all this new supply coming on, which is exactly what happens when prices are very high. It's a great incentive to produce more. So now we've got all these wonderful supply options coming on stream in volume, just as demand is falling off even further. And so that's all good, but people are saying, well, this will be a huge boon to the economy. I think they're misunderstanding what has in fact been driving the economy. So when you get break-even rates, which are below the current price of oil on some of these projects, for example, the oil sands, the whole Keystone debate, everyone, the House passing the bill to go ahead with Keystone last week, great, except the math doesn't make sense now because oil's below the break-even point on much of that stuff. So, it's great that prices are coming off in terms of affordability for consumers, but in terms of GDP growth, again, this is one of those things that most people didn't see coming. And I push back on the idea that no one saw it coming, because many of us did. But the sell side certainly was talking about, more. They always talk about inflation, right? They always talk about more demand, rising prices, higher and higher earnings every year. They don't ever consider the impacts of a deflation in something like a major commodity price, for example, or the fact that earnings have to mean revert. And when they do, you're going to be looking at these crazy prices on equities and saying, what in the hell were we thinking? Why did we borrow long to buy back our own shares at record valuations? And here's a real story, but this one got me this morning. I'm listening to this nonsense. I agree
with you on that one.
This nonsense about we're returning money to shareholders. It's like, well, if your shareholders are smart enough to take those elevated share prices and sell them and take their cash out of the system, then that in effect is returning money to shareholders. But if they are foolishly holding those shares at these record valuations that you keep buying back and making more and more expensive, then they're going to find out the hard way that that's not the same as cash in the bank. Because when those prices come back down, the companies are left with the debt and the share values plunge, and there's no capex PS because it doesn't make any sense in this environment for those companies to be investing in building out a business model when revenues are falling year after year. So it's the capex boom. Look at what drives GDP. You've got households, consumers, which are still under a debt burden that's holding them back, and weak wages. You've got business, which is not going to be driving capex here. I mean, most businesses weren't doing much capex to begin with. The bulk of it was coming from the oil and energy revolution in America. Now you got lower prices. You're going to see a cutback in that. And then you look at government. And you go, well, is government about to ramp up more spending? I mean, and then exports are being hurt by a higher dollar. So I just think growth is going to keep disappointing people. And, another thing is high yield debt yields. You've seen high yield debt, the spread between high quality and low quality corporate bonds has been widening here significantly in the past few months, even as the stock market's been going up. That's another sign of distress, typically, where, they're starting to look at the financial fragility of these corporations now because they have borrowed their eyes out. So they've borrowed so much that they're now literally on the brink of insolvency, many of them, and yet the price of their bonds has been caught in this QE mania. So they're trading at these insanely high prices. So there's just so many disjoints in this system at the moment. And, some days it can feel like it's hopeless, like it'll never realign with reality. And other days it's so garish and ridiculous that it's literally comical. Like some days I find great comic relief in watching, the craziness around me. And, the trading commercials these days, there was one this morning, some woman walking around with her cell phone talking about, it's like a Charles Schwab new, now I can trade, my brain's out all day long. When I'm walking through the grocery store, I can be trading. When I'm on the sidewalk, I can be like, what? This is what we've done is we've taken this whole idea of gambling, online gaming, buying scratch tickets, playing the stock market. It's all become this one big addictive, gambling, destructive disaster. And, I really look forward to the purge where, it washes out again and people say, what were we thinking? What were we thinking?
Mm-hmm. Yeah, it's inevitable. There's a real inevitability to all of this, Danielle. People just don't learn. There's nothing new in all of what you've been describing. And the human nature to gamble, to make easy money quickly, a lot of it, it's been with us. I think it's the world's third oldest profession, after prostitution and politicians, which probably is one and the same. Basically, that's it.
Well, unfortunately, free money makes us weak and I was going to say fat. I mean that in a figurative sense. Fat, it really does. It doesn't make you sort of disciplined and strong. It depletes. It tends to sap the strength out of people in the system. And so that's where we've been through this, this era of quote free money, which has come at such a great cost to everything that matters in the long run. But but then again, it's only zeros, as I say, and I'm not, I'm quite confident that it will resolve, as all things must, with a bit of reality and a loss of zeros. It does test our patience in the meantime. Jeremy Grantham's quarterly letter was saying that he thought that we could easily see another 10% on the S&P before it absolutely blows up, basically. So, there's a guy who called the top in 2000 early in 98, nearly lost half his firm's assets because people bailed on him because he pulled out of equities early. He did the same thing in 2007. He was like us, concerned about valuations early. And so I think he's learned to stay longer and hope for the best. Well,
that's like lighting the fuse on the dynamite, knowing it's a short fuse and hoping you'll be able to run away from the thing before it blows up,
Only in this scenario, I like that analogy because, my book, Juggling, Dynamite, I always saw my job as a juggler of dynamite. But the reality is that, as a money manager, as an investor, it's not good enough to just throw it at someone. You want them to give you the face value for it. You want them to give you liquidity before it blows, right? So this is not so easy as just tossing it at someone and running. You actually need them to exchange some kind of actual currency with you to take that ticking time bomb off your hands. And I think that's where it gets tricky because the liquidity, the volume participants in these markets is so small relative to historical levels that, that's the rub. Who is going to be on the taking end when everyone tries to toss their dynamite, and that's why, eventually all that progress tends to evaporate quickly.
That's why something's got to give, Danielle. You know it. Something's got to give. And maybe it's not going to be this week. Maybe it's not going to be this month. Maybe it's not even going to be this year or next.
Oh, my goodness.
The longer you wait, the worse it's going to be. And,
and the more likely, frankly, it'll be the final wash of the secular bear. I mean, when we first started into the downturn, I knew in 2007, our downside target was to revisit the 2002 lows on the major indices. We, in fact, did that and overshot it to the downside a little bit. When the recovery began in 2009, we thought that it would be a subpar recovery in an economic sense and that you'd have a short bull market relative to historical standards and then a more severe downturn, at least one or two more severe downturns. So what they've done by the elongation of the QE programs is really allow the recovery, the stock market recovery to go on at least 2 or 3 years longer than it organically could or should have. And so I think that you've also sort of mushed the potentially 2 more downturns in the secular bear into one big massive one now. And that means that although it's been painful to wait for this final retest to take place, I think from these levels, it's more likely that we're going to have one more massive washout, and that will be enough to sort of send the risk sellers from the building for several years to come.
Hey, it's why do people go watch the Indianapolis 500, Danielle?
Why?
Because they want to see that big accident.
Oh, God.
Hey,
but are they standing on the track while they're watching that, or are they in the stands?
They're in the stands. Well,
you see,
you and I are in the stands, right?
If you want to watch a shit show, stay in the stands. Don't stay on the track. That's my motto.
Yeah, exactly. So on that note, find Danielle's excellent blog, jugglingdynamite.com. We've got a link to it in our site every week. And always great stuff there, especially that JP Morgan witness, the $9 billion witness. It's really far, far greater than $9 billion, Danielle. We're talking hundreds of billions of dollars of crap that were sold during the financial crisis in the form of AAA rated bonds, mortgage-backed securities. There's so many good stories this week, Danielle, that I didn't even know where to start. And hey, come over to financialsurvivalnetwork.com. Our webmaster, Stefan, second to none. We've got hundreds of stories a week that the mainstream media either doesn't want to cover, refuses to cover, or doesn't understand. And really want to stay informed. It's a place to go. Sign up for a newsletter, Danielle. Hey, 2 weeks. We'll talk to you then.
My pleasure. Bye, Kerry.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.